Hey everyone, welcome to Tuesday's edition of the PPP loan forgiveness, and we have deviated from our normal live Q&A with Adam because we just received this recently, the PPP loan forgiveness application, and there's some specifics in there that we felt like we're going to bring you our two best and brightest minds in this particular area. So Adam Boatsman and Blaine Hawkins are going to dive deeper into that, and then we will be answering that. We've got some FAQs that we've used and that we've had from the last few weeks from you guys that will kind of reiterate, but so we've deviated from live, so thank you for tuning into this. So Adam, I know you've got some thoughts as a typical preamble here, so why don't you go ahead and take it?
Yeah, thanks, Gary. And thanks, Blaine, for participating in this one. For those of you guys that don't know Blaine, he's the brains behind the operation that's been working with our team to come up with all the forms, emails, and templates that we put out. So looking forward to what he has to say in his analysis on this. From a timing standpoint, in the earlier webinars, our advice had always been, we don't know. This is our best guess at the time based on what we've seen in our interpretation. Here's some speculation, but don't make any major changes until probably first or second week in May. Hopefully some guidance will come out by then. Well, here we are. I don't know if this is the second or third week in May, but it's about the time that we were hopeful the guidance would come out. And I do feel like while this particular form is still got some issues, it really did provide a lot of clarification and guidance on things that we had been speculating about in the past. So I'm happy that it came out. And from the what should you be doing standpoint, it's really, as we'd said before in the webinars, don't really change anything that you're doing today. But now that we have this guidance, it's time to develop the plan to maximize your loan forgiveness within your 56-day coverage period, within the confines of this document as we know it today. Now, there's probably going to be some changes because, as Blaine will point out, there are some actual, straight up, flat out errors on the form that'll probably need to get corrected. We expect some additional guidance to come out, but I think the basic blocking and tackling of how you're going to calculate what's allowed and what's allowed for the purposes of forgiveness, I don't really see that changing a whole lot from the confines of this document. So let's just talk about a couple things that they did clear up that we had some speculation on in the past. The first one was the subject of owner payroll. A lot of people had questions around, if I pay myself, a bonus, or I always pay myself at the end of the year, or can I give myself a raise if I'm an S corporation? I take, low wage, higher distributions. Our guidance at the time was it shouldn't really matter as long as you're at the 100 grand annualized, which I think they clarified specifically in this document, clears up all ambiguity. I believe it's $15,360 is the number for the 56-day period. Blaine may correct me, but off the top of my head, that's what it said. So they cleared up the ambiguity around the total amount that you could pay, one. And two, on the subject of owners specifically, you can't exceed the $15,316 or $360 point. But even more importantly, they very specifically said, and oh, by the way, you can't give yourself a raise in the course of doing that. And the way they got there is they said that you have to look at 2019, and what you can claim is the lesser of 2019 or what you're reporting in 2020. So what that tells me is that if you flat out paid yourself less than $100,000 in 2019, at this point, you're probably out of luck on the giving yourself a raise standpoint. But if you were just giving yourself distributions and at the very end of the year, just for mechanical purposes, you did one W-2 for $100,000, you're probably fine doing a payroll run in this interim period. So that was the first thing they cleared up. The second thing they cleared up we had a lot of questions around, hey, I just got funded, yesterday, my first payroll's today, but I paid 2 weeks in arrears, and they definitely cleared up that the payroll costs themselves, and it doesn't matter what payroll costs they are, but the payroll costs themselves are payroll costs incurred in the time period. And for the purposes of time period, two key distinctions there. First off, is incurred. That means it was actually earned. So if that first payroll run happened one day after you received funding, and you pay 2 weeks in arrears, by this document, that payroll would not count, but for 1 day potentially. Now that turns into a complicated science project. So what they also did, for the purposes of payroll costs only, they came up with the concept of an alternative period to start your 56-day clock. So if you remember from our original guidance, people kept on asking, when's the time start? When's the time start? When's the time start? And our answer always was, when you got funded, when you got funded, when you got funded. Well, they did provide some relief on the payroll front side to say, look, at your election for payroll costs only, you can either pick the start date of the day that you got funded, or alternatively, the date of your first payroll within the covered period that covers salaries earned. So in that scenario, they gave a couple examples in the document, but if I got funded on the 31st, as an example, and I pay bi-monthly, and it's always a half month in arrears, I could say that next payroll run, the 15th, which covered, that's the first period that I have, earned wages. I may have gotten that math wrong, but effectively, the first payroll that covers earned wages in a period, you can also use that date as your starting date for the purposes of calculating your clock. So they gave you a couple flexible options, so it didn't appear as if you needed to alter your payroll, because either you're going to prorate it based on the 56 days, or you're going to have your start date be clean with the payroll that represents the first date period that you would have had earnings. And then the other thing they did with that is they also said, look, if you have a payroll that happens outside of your 56-day period, but it covers period within the 56 days, you can include that as well, as long as it's paid on the next payroll run. So what you can't do is just a myriad of accruals that go on to the end of the year. But what you can do is go ahead and claim some payroll, even if it's paid outside of the 56-day period, as long as it's paid in your next payroll run. So that was good. Next thing they did is they clarified the FTE count in a lot more, wouldn't say necessarily more detail, but they cleared up some ambiguity. First off, it's a 40-hour week, so that's good. It's not according to ACA, it's a 40-hour week. Secondly, if you're just not going to be bothered with counting up a bunch of hours, you can just use 0.5 as an alternative calculation. So I'm either full-time or I'm 0.5. So that'll be up to you on making a judgment call. If it was me, if I had a bunch of 0.75ers, I probably would go the 0.5 route. But if I had a bunch of 0.25ers, I might go the real calculation route. But they gave you an easier way to calculate the FTE count. The other thing that I think was really important is, previous guidance had said, look, you're not going to get penalized on the hiring back FTE count. You can go ahead and count them. So the mechanism is you count somebody in the calculation. If you made a job offer and they rejected it to come back, that still counts as an FTE. Well, they also added a few more classifications to that. First off, if somebody voluntarily resigned or otherwise voluntarily asked to have their hours reduced, that still counts for you. So in the case of somebody that was on, took leave and just reduced their hours, that doesn't penalize you for the purpose of the FTE calculation. Even more importantly, if you separated somebody for cause, they also count in your FTE calculation. Now you can't double count if you replace the position. You can't say, hey, that guy left and I also have this new guy. You're not supposed to do that. But if you fired somebody for cause, had not replaced them, they still count in your FTE calculation, which was new information for us. And then lastly, for the purposes of what are your test periods, we had been saying there were 3 test periods, and that's still true, but the test periods got real laser-like in the clarification. At the election of the borrower, you now have 3 test periods. 2 of them are the same as they were before. One of them is, what'd your FTE count look like from 2/15 to 6/30/2019? That's number 1, test period number 1. Test period number 2 is the FTE count from January 1st, 2020 through February 29th, 2020. So you don't have, it's not like, hey, I have to do this one, then I have to do this one. I'm picking one or the other. But then what was really interesting on the last piece, and it says for seasonal employers only, whatever that means, you also have the option of looking at the entire period between 2/15 and 9/15/2019 and picking the average of a 12-week period anywhere within that. So that covers a pretty broad spectrum of different time points in that third alternative calculation you can do to get to your FTE count. So they clarified the FTE count, and I think the last thing that they really clarified that I think is really important is the documentation requirement. There's been a lot of back and forth, especially, when they were still talking about, hey, you might get audited and go to jail, about what documentation do I need? Well, they broke it up into 2 categories. Documentation you need to give to the bank, and documentation you need to keep and retain for whatever purposes you need to retain it. So the good news is that on the bank side, because that's all of it matters, but that's stuff that's really going to matter, it's effectively the application form is going to get submitted, some form of payroll records that supports that the payroll was actually paid, the underlying bills and associated bank statements for both payroll costs, which would be primarily healthcare and retirement benefits for the covered time period, and then for the non-payroll related costs, associated bills and receipts that you paid them are the documentation requirements. So it's not, it's more stuff in the application process, but it's very similar types of documentation. We believe it's not too onerous on you or the bank. And what's also interesting about that is what's not included in that documentation request to go to the banks are all of your underlying calculations that support what you put on the form with respect to employees making over 100 grand annualized, and all that, the FT count and all that kind of stuff. That's your information. That's not information that, as of right now, it appears that you need to provide to the bank. They may still ask for it just to make sure you got it right, but that wasn't in this initial pass. So it's good news from a clarification standpoint, but there's still a lot of questions. So with that in mind, Blaine's put together some supporting documentation around, all right, here's what we really, really know in terms of what you need to be counting on that he's going to go through next. So off to you, Blaine.
All right, well, thanks, Adam. I appreciate the opportunity to join this, and also particularly thanks to you and Gary for conducting these twice a week webcasts. I've been getting lots of good feedback from clients and others that this has been quite helpful to them. But let me just give some foundational refresher to our viewers. First of all, you recall we've got this 8-week period that begins with the date your loan was funded to add up all of your qualifying costs, and hopefully those will equal the total amount of your loan, and you'll get a full forgiveness for that loan. And just as, again, as a refresher, there are 4 categories of costs: your payroll, rent, utilities, and mortgage interest. So let me talk a little bit about each of those, and Adam, feel free to jump in and add comments as you think are appropriate. So payroll includes your gross payroll. As Adam just described, we no longer have to worry about what was actually paid during the 56 days. It's only the payroll that was earned during those 56 days. And the 56 days, again, repeating what Adam said, can begin either with the date the loan was funded or you can wait and start it counting your 56 days with the first date of your payroll after that date. The latter just makes it easier for you to pull together your payroll reports and support the information that you're providing for your loan forgiveness. So in addition to actual payroll costs, you have employee health benefits. We think those are the ones that are paid during that 8-week period. You also have employer-paid retirement benefits. Our interpretation of this loan application is we got a favorable position on that. We first thought it might be only the retirement benefits applicable to the 8 weeks. But what it says is it's the retirement benefits that have been incurred and that are paid during the 8 weeks. So right now, our interpretation is that you could, if your normal profit sharing contribution is 10%, that you could calculate 10% of your year-to-date earnings through the end of the 8 weeks, and that would be a qualifying cost. Now, we may get some later interpretation that says that's not right, but that's what we see right now. It also appears that if you have accrued your 2019 profit sharing contribution, your employer contribution, even though that's not a 2020 expense, that it has been incurred, and if it's paid during the 8 weeks, we think that's likely, well, it's possible that could be a qualifying cost. So those are the major payroll ones. I think some of the other questions have been bonus amounts. We think if you can pay a bonus or need to pay a bonus during that 8 weeks to get up to your total payroll cost, that should be of help. Temporary salary wage increases should work. Dental, including in the insurance, not only health insurance, but we think also dental, vision, disabilities possibly could qualify as health insurance costs. And remember, you're trying to fill up this forgiveness bucket with dollars. And so to get full forgiveness, at least 75% of those dollars have to be from your payroll costs. So this is an area you really want to focus on and ensure that you meet that total 75%. The next category of costs you can look at would be mortgage interest. When you hear the term mortgage, I think you immediately think of real property mortgages. But the language of the act, and it's in the application forgiveness instructions as well, also say it can be interest on personal property loans. Now we think those need to be secured loans. That's the nature of a mortgage. It is secured. So if you have equipment loans, automobile loans, that interest should also qualify. For rent, again, you immediately go to your occupancy rent. We originally were concerned it could only be the rent for the 56 days. Again, it appears from this application that it's the rent that's paid during the 8 weeks. So let's take an example that your loan was dispersed to you on April 21, and you had not already made your April rent payment. It was due April 1, you didn't make it because you weren't sure about getting your PPP loan. It appears to us from this application that you can make your April rent payment after the loan is received. You could then also make your May and June rent payments and possibly get 3 rent payments within the 8-week period. So really until they come out with something and tell us that's not appropriate, that seems to be allowed within the terms of this application. Remember that rent also includes personal property, so copier leases, equipment leases, anything that you're paying rent on should qualify. if you're looking at leases, just make sure under accounting terms that they are true operating leases, meaning they're true leases, and it's not a disguised finance arrangement. Utilities is the last category. Now I'll read these out. It's electricity, gas, water, transportation, telephone, or internet access. All of those are pretty clear, except for transportation. We get a lot of questions on what is transportation. We still don't have much on that, except there was some guidance that came out from SBA. It's not in this recent forgiveness application that says that automobile gasoline could possibly be a transportation cost. We also think you ought to identify maybe trash service, security monitoring as other possible utility costs. And if we need to fill that bucket with those, we can take a look at that. So that covers all of those. I would say it is pretty clear that because the term is incurred and paid, incurred meaning all events have happened to fix the nature of the liability, that any prepayments are not going to be allowed. So, you know, prepaying health insurance, prepaying interest, prepaying rent, those costs, at least at the moment, we feel like are not going to be qualified costs. All right. So Gary, that kind of covers the, you know, those categories and additional guidance that we got today. So we'll turn it back to you.
Okay, thanks so much. So gents, thank you for your clarity on this as we're trying to bring clarity as it's still evolving. Some of these questions that I'm going to ask, you've already answered, but I want to ask them again because these are ones that have come kind of frequently in the past few weeks in particular. So I'll just rock down these, you know, dozen or so questions, and then I'll, you know, Adam, if you would just say, yeah, I got that one, or pass it to Blaine, that's fine. So the first question is regarding the timing of PPP loans. If it was received recently, is it 8 weeks from the time the money was received or June 30th?
So it's 8 weeks from the time that the money was either received or at your election when you pay the first payroll that represents wages that were earned on that payroll run.
Great. Next question is demonstrating the need for PPP. There was a lot of angst about that, especially when we didn't know, are you going to go to jail if you didn't really need it? And that need was really ambiguous. So we've gotten more clarity on that, but how do we demonstrate or prove the need when at the time the applications didn't look good, but revenues are now going up for us? We've seen that with construction folks.
So below $2 million in funding, it doesn't matter anymore whether or not you demonstrate a need. On the application itself, you are checking a box saying that you received over $2 million. And then there's some certification language that happens regardless. So you're certifying that you had a need regardless of whether you're $2 million above or below, but nobody's going to look further if below 2 million. So above 2 million, you check a box, you are above 2 million, and there is still no guidance on what you need to prove that you needed it. So I think our original guidance still stands that, you know, even if you're up today, it doesn't mean you're going to be up tomorrow. So especially given, you know, all the reporting around nobody really knowing what's going to happen now that the states have started letting up shelter in place rules. So that's going to be your best judgment call on what you think the rest of the year is going to look like.
All right, great.
And Adam,
Go ahead.
Again, Gary, just add to that. I think it also said for those that are over 2 million, if you're determined that you did not make your application in good faith, the penalty is you don't get forgiveness and you just repay the loan.
Right.
There's some indication in there would not be any kind of sanctions or penalties or criminal concerns with that.
Yeah. Yeah, I'll hit on that too while we're there, Blaine. And again, this is just a speculation. There's no, if Jack was on this webinar, he would say this is a Jackism. So I'm going to claim that as my own. There was a news report that came out that the Department of Justice had subpoenaed loan records looking for fraud. Knowing about fraudulent cases and the last guidance from the SBA, I don't think that fraud's going to be related to anything related to, did I really need the money or not? I think that's going to be more related to traditional bank fraud, which is, I gave the bank one thing and I reported the government something else. So using this example, the 941s that you use to submit the application in the first place, well, the bank never asked for the transcript from the IRS that proved that's what you actually filed. And they're also not asking for transcripts proving that when you ask for forgiveness, did you actually really pay that or not? I mean, presumably it's on the bank statements you're going to give them, but even those could be falsified. So, my feeling about the fraud thing is don't lie because, there is a chance that, they're going to spot check some stuff specific to fraud in their traditional bank fraud sense, not in the, hey, did I need the money or not sense.
I agree with that.
Next question is regarding mortgage and rent. Is it considered back pay if we pay now but couldn't afford to pay it before the PPP funds hit? Can we prepay upcoming rent?
Did take that one, Blaine?
Yeah, so I think there were two questions in there. So one is if you've got rent, interest, or utilities that are in arrears that you were not able to pay prior to the date you got your loan, then we think those can be paid during this 8-week period, and that would count as a qualifying cost. But it's pretty clear that any prepayment for costs that are really not due until after the end of your 8-week period, those are not qualifying costs.
Great, thanks for clarifying that. So the next question is actually two questions on EIDL. The first one is, are EIDL grants tax exempt income? The second question is, how do EIDL funds received impact PPP loan forgiveness?
The application's silent on the loan piece itself. It asks you to put in the grant amount, but maybe Blaine, you could address, since you have the form in front of you, what's it actually using the grant amount for on the form?
I would need to look through that in detail. I didn't really, unfortunately, I didn't focus on that in the form.
I mean, regardless, it's just, I know it's a lot, it's $10,000, but it does ask you to disclose, one of the speculations we had is, what are people going to do with the grant component? It does ask you to state what the grant is. So that's going to be used somewhere.
The next question, I think you addressed it, but I'm going to ask it anyway. It says full-time versus part-time headcount as part of the forgiveness. So the question was, if I had more part-time and less full-time prior to COVID-19, but now I have more full-time but fewer part-time, resulting in a lower headcount, will I still be penalized?
Again, it goes back to the the real FTE calculation is anybody over 40 is 1, anybody below 40 is whatever the fractional component of the FTE is. And if you can get to, if it's just easier to round to 0.5 and that gets you to a better answer, use that. The other thing to consider embedded in that question is if the person let anybody go for cause or anybody asked to voluntarily have their hours reduced, you can count them as well. So it may not be as bad as that original question implied when asked.
Next question includes employee headcount again, and this is average headcount during the 8-week period or the total on day 56.
You gonna take that one, Blaine?
I think the form calculates it, the average for the 8-week period. And I guess we might just mention there the rehires exception, that if your FTE count during the 8-week period is lower than the base period to which you're comparing it, you do have the option of rehiring that individual before June 30, and they would count in your 8-week FTE. And we also got some further recent guidance. I think, Adam, you discussed this in one of the prior webcasts, that the person doesn't actually need to come back to work for you as long as you make them a written offer. So if you make them a written offer, but they decline to come back to work, that still counts as a positive in your FTE count.
Yep.
Next question happens to deal with partnership distributions. And this has come up a number of times. Should we switch to a W-2 versus distribution?
I automatically punted that one to Blaine.
You got that one?
Yeah. Yeah.
Do you want me to answer that one?
Yeah, if you don't mind.
Well, if you are an LLC or a partnership and you're being taxed as a partnership, then the owners can only take distributions. They cannot take a W-2. So that's existing income tax law. But what Adam described earlier is the instructions to this forgiveness application did make it clear that during this 8-week period, they just say it's the payments to the owners that count as payroll costs. With the caveat, again, Adam mentioned this early on, that the 2020 payments cannot be more than the 2019 payments. So your only choice is to look at the distribution to your members or partners, and W-2 is not an option.
Great, thank you for that. Next question deals with wages. Would retirement plans include cash balance and profit sharing? There are actually a few questions in here. The next question is how to handle commission-based employees. Wondering about hazard bonuses, so that's the third one. And the final one in that is, can we increase our safe harbor contributions?
You gonna take that one, Blaine?
Well, the definition of retirement plan only makes reference to employer contributions. So whether it's a pension plan, 401k plan, a profit sharing component of a 401k plan, or a cash balance concept, as long as it's the employer contribution and it was paid during the 8-week period, we think that qualifies. Now, I think if you're making your 2019 contribution that was accrued at the end of 2019 but is not due until September 15th, we think that qualifies. If you're doing 2020, I would be a little bit more cautious and only calculate the employer contribution on the year-to-date compensation through the end of the 8-week period, just to meet this incurred test that's in the statute. And Gary, there were some other questions there about not about retirement plans, but about some commissions.
Yeah. The other one was about how do you handle commission-based employees and then also hazard bonuses?
Well, with any of these, you need to make sure you're not paying an individual more than the $100,000 a year annualized rate. But assuming someone receiving a hazard bonus or a commission is under that, we think as long as that commission was earned during the 8 weeks or the bonus was declared, that's up to the owner. If they declare a bonus out to everybody, those ought to be qualifying costs.
Great. Next question is non-payroll, the 25% that was non-payroll. So what all is included in utilities? I know you've dealt with this, but I just thought it might be worth doing it again. Software as a service subscriptions, are they included? Equipment loans, fleet fuel, auto loans, intercompany loans?
You might hit that one, Blaine?
Yeah. So the utilities we mentioned, all of those, I'll just read them out again real quick. Electricity, gas, water, transportation, telephone, or internet. In addition to that, we've seen something that says that sanitation, trash service may qualify, and security monitoring might qualify. Haven't seen anything about software costs, so I'd be skeptical of the software costs. And then the rent payments, clearly you can include not only your occupancy rent on your space or building, but rent on equipment. So if you're leasing an automobile that's a true lease, you're leasing some manufacturing equipment, leasing a copier, that all should qualify as rent expense.
What
And there
about
may have
fleet
been something
fuel?
else there at the end I didn't.
Yeah, fleet fuel.
Right. So we do. It's possible that gasoline. There's some language in one of the pronouncements that says that gasoline is a transportation expense.
Great.
But we might distinguish gasoline. We've had some questions, Gary, about automobile mileage, where they're reimbursing their employees at a standard rate of 58 cents a mile or something like that. It's questionable whether that qualifies.
Okay, great. We're in the home stretch. Two more buckets of questions, if you will. So the first one happens to deal with self-employed or Schedule C expenses that could be forgiven. So this has three questions to that. So what are the requirements in order to be granted for forgiveness? Office and home rent and expenses, do they qualify? Or what about retirement funding?
I think we've already addressed those questions. We don't see that being really any different from the business guidance, which, as long as there's a pattern of paying these things and they were incurred and paid during your time period, it's going to be no different than what Blaine and I have already talked about.
Okay. Final question.
Gary, let me just add to that.
Yeah.
It did say for self-employed individuals who, that the payments to them, you look back to what was paid during 2019 and you take 8/52 of that. Now what's not clear is this also talks about 2020 payments if you have to take the lesser of the two. Well, you're going to be limited to 2019 anyway, so I think that's the number you would use for your owner payroll.
Final question for you all. This topic is, the company is still closed under mandates. If we fail to meet payroll expense forgiveness mandates, since we can't open, can we still get forgiveness on the 25% of utilities and rent?
Doesn't appear so.
All right. Well, those were the frequently asked questions from the last few weeks on these live Q&As. So if somebody has additional questions that have not been addressed here, you can feel free to hit us with FAQ@trustbgw.com. Again, FAQ@trustbgw.com. And then the final thing that I think I would say, and then you guys can chime in, but we are here to help. We're doing this freely to help other business owners like ourselves just navigate these crazy things. And so we actually have a few offerings in this spectrum. So the first one is self-serve, like we're just freely giving you this information. On the other extreme is, hey, this thing is pretty complicated that just came out, and I want you to handle it soup to nuts in helping us with the application. We can do that. Or you want something kind of in between where you need some help. You're going to fulfill it, but you want some consulting on the front end. We can help with that. If you want that sort of support, just send an email to FAQ@trustbgw.com. Send it to FAQ@trustbgw.com, and then we will filter that to the right team inside of our team to do this. We've set up a dedicated group right away with the CARES Act when that was coming down the tracks. And so we are prepared to handle that, but we are here to serve you. We will be back live again, probably as early as Thursday. We'll see. That is yet to be determined, but we'll continue dealing with these webinars as long as there's issues that we need to help address. So anything else from your guys' standpoint?
I guess the big thing, a lot of the commentary that I said during the previous webinars is so goes the application, so goes the forgiveness process. That, part of that is still true, but in terms of this application itself, it probably is about 10 times harder, if not more so, than the original application process in terms of supporting schedules that you're supposed to use to calculate. So just, be prepared that it's not, it's not taking a number from a 941 and slapping it on a sheet of paper. It's every employee, what'd you pay them? You got cutoff periods of what pay dates, what payroll occurred where. So it is a lot more complicated. So as I'm saying it out loud, maybe 10 times the effort, maybe widening it, maybe it's 20 times the effort. So just, make sure you take a look at the application and get thoroughly familiar with what it's going to take to get it right.
And Gary, I might just say, frankly, I was pleasantly surprised with the way the application came out and some of their definitions. It was much more business friendly than it could have been. So I think there's some encouragement in that. I think all of our viewers should also be aware that through trade associations, including our CPA, National Association of the AICPA, individual businesses, all the lawmakers are well aware of these issues that are still unresolved. Your last question about, I've got my loan, but my business is still closed, therefore I can't pay my employees. The issue that the 8 weeks is too short. The issue that the IRS came out and said, yeah, the loan forgiveness is not taxable, but the expenses that you pay with your loan proceeds are not deductible. All of those things are in front of the lawmakers. I've learned never to predict what lawmakers may do, but there is some expectation that they will have some corrective legislation that will make all this PPP process even more friendly to businesses than it already is. But obviously, if any of that comes out, we'll immediately get it out to all of our viewers and readers of the emails.
Any parting shots, Adam?
No, we're good, buddy.
All right. Well, everybody, thank you for faithfully tuning into this sideshow on top of our other jobs. But hopefully this has brought value. That has been the aim and the intent for sure. And this will probably not be the last you hear from us. So thank you again. Again, if you do want some help in that, hit us with an email at faq@trustbgw.com, faq@trustbgw.com, and we will jump on it. All right. Thanks again. You guys have a great week. Bye-bye.
All right. Great.